can often look at their P&L and you can see the difference between those that have pretty firm risk management in place and those that have this really cavalier style attitude, which is like 1 month absolute hero, next month zero.
Well, I guess it's simply to do with human nature. It's not interesting, and you'd rather want to make money quickly. That's also what a lot of people want to do, and you don't realize that it actually all comes down to math. It's as simple as that. And if you risk too much at one stage, you're just going to blow up your account.
How do you preserve your balance and trade in a way whereby you're trying to make consistent gains?
There will come a point in your trading career where suddenly you get 5 or 6 in a row wrong. It's not your system's fault, it's just the way it is.
Most trading books, textbooks, people you speak to know the rules of never risk 2% of your account, 3% of your account. But why do people not do it? Welcome back to Talking Shop with IG. I'm your host, Luke Moore. I'm joined this week by Pete.
Hi there, how are we doing?
Very well, but it's the big one. I'm so excited to have this special guest on. Introducing you to the world of Talking Shop. We're joined for this special episode by Axel Rudolph. Now, Axel is our in-house technical specialist. Anything to do with data, maths, and everything that we've been talking so far about in this Tradecraft series is summed up nicely by Axel. And we were just talking former chair of the Society of Technical Analysts, current head of education, current market analyst at IG. Axel, welcome to the pod.
Thank you very much, Luke and Pete. Glad to be here.
I honestly, I think when we look at kind of more mechanical-based trading, I've learned so much from you just in my own trading, just through chatting, listening to your webinars, listening to your seminars. The risk-based rules that we're going to talk about today, I've learned it all from you.
Yeah, a lot of what we've been talking about really has become out of your sort of playbook of how to kind of navigate the market, but mainly by applying risk management, isn't it? And what to use. And I know from what we've done in client workshops, that's where I've kind of learned, where I've been in the classroom with the clients and actually looking at what you got to say. So yeah, welcome.
Well, thank you very much for this introduction. I mean, obviously what helps in my case is that I'm a little bit older than you both are, and I've been around a few times and have blown up accounts myself back in the day, etc. So I learned the hard way, like most people do, I guess. And yes, it all boils down to risk and how do you control that risk, and position sizing, which we're here to talk about today.
Yeah, completely. I think with Talking Shop, to kind of introduce you to the world of Talking Shop, off air, by the way, said he's never listened to a single episode. I got to throw you under the bus.
I don't have the time, as I said. I'm so busy doing other stuff.
Trading.
Too busy. But so to just warm you up to kind of the world of Taking Shop, we don't take ourselves too seriously. But what we do want to do is make sure that we give good information, draw on our years of knowledge in a way that we can help clients, which is why this series is specifically about what we call Tradecraft. So today is all about position sizing, which I think is still the biggest killer of retail accounts, why some people are really successful and consistent, and why some people are really inconsistent and have hugely volatile P&L swings. It all comes down to position sizing.
Yeah, it's that yo-yo, isn't it, between people that you can have, we look after, you and I as premium client managers look after typically between 100, 150 clients each, premium clients of IG, so either high volume or high net worth individuals. But you can often look at their P&L and you can see the difference between those that have pretty firm risk management in place and those that have this really cavalier style attitude, which is like 1 month absolute hero, next month zero. And I guess what we're trying to do is trying to chat and speak with the clients and show them ways that they can actually have more of a sustained sort of lifetime with the product that we offer, which is a high risk product, right? And so I think your bits and pieces that you've shared with us so far are very, very useful.
Well, we were just having to think about how we set this conversation up. What do you think is the biggest trade you've ever seen? People always ask this, how big is my account versus other people's? What's the biggest P&L you've ever seen? So just to kind of introduce the topic, what do you think, to both of you, what's the biggest trade you've ever seen?
Well, I traded futures and options back in the day in the 90s at Society Generale in Paris, and we were basically executing trades for the fund management arm of that bank, which back in the day was the biggest in France. So yeah, it was billions.
Yeah.
But obviously you have to put everything into context. And it's totally different if you trade retail money than if you trade institutionally. But yes, the biggest size was that sort of thing, literally.
Yeah, I think back in the day, I remember finishing a late shift, which obviously when we cover the US sessions, and I think by the end of the night, it worked out that I'd traded maybe 400 to 500 million notional in Apple, in and out as well, like frequently, in and out, all on the phone. And like got to the end of the session and just like, Christ, I need a beer.
All with the same client.
Yeah.
Well, I did that for
Ferocious.
institutional clients in-house, and yeah, it's exhausting,
Yeah.
isn't it? I mean, it's just...
I remember once we're talking kind of 10, 15 years ago, we had to model our risk with and without one client's FTSE exposure.
Right.
So we had to say, if they've taken that off, what does that mean for the rest of the exposure that the rest of our clients are given? So there's some pretty big trades that float around.
Yeah, absolutely. Yeah.
There's some pretty big trades that float around. So to kind of ask the first question then, why is position sizing often overlooked? Why is it that it seems to be the root of all evil when you're over leveraged or you're stressed and all these things? It all comes back to having the wrong positions on at the wrong time. So why do you think people overlook it so much?
Well, I guess it's simply to do with human nature. It's not interesting, and you'd rather want to make money quickly. That's also what a lot of people want to do, and you don't realize that it actually all comes down to math. It's as simple as that. And if you risk too much at one stage, you're just going to blow up your account.
We've done an episode on math. We kicked off this series with a maths episode because I think you're right. I don't think my day-to-day, when I'm talking to clients, I don't think people think about it at all. I mean, I've got a client that I trade for every single day. He will trade a fixed number of shares in the big UK banks, 100,000 shares, in, out, in, out. And it doesn't matter whether he's profitable, whether he's loss-making, it will always be the same size.
Mm. Per product or per, as in, I'll always do 100,000 of any bank.
Well, this is the thing.
Yeah.
100,000 Lloyds at 70p
Yeah, it's
is
very
not the
different to
same.
100,000 Barclays. Yeah.
Correct, at £3 odd.
Yeah.
Yeah, completely. But no, they don't even think about it.
And also, I mean, it depends on how much money you've got available. Because I mean, if you've got a £100,000 account, you can trade different size than somebody who's only got £10,000 in their account. And yet you will see people risking far too much, for example, £5,000 on a £10,000 account, and hope that trade is going to work out. And well, if it doesn't 3, 4, 5 times in a row, you're out. Probably even quicker.
True, yeah. We touched on that before, saying that if you had a 10 grand account and you risk 5 and it goes wrong, you've halved your account immediately, which means you've got to perform at 100% to get back to where you started, which is literally just where you're not even making any money.
Exactly.
And to return 100% is quite a big ask. And so that is, that kind of feeds straight into this, which is how do you preserve your balance and trade in a way whereby you're trying to make consistent gains in a more kind of enhanced risk format, or being more mindful of the risk. And it does come down to position sizing. So I think the way that I try and speak to my clients about it is to say, like, what is the notional size that you want to be swinging in the market? And once you know that, and then you can divide that into the product pricing, you can work out then your pounds per point, or lots, or if you're trading CFDs, and then obviously where you want your stop to be. So I think I think when you have a conversation with clients and they're not aware of the notional size, that's where it becomes a real, the first point is, right, do you want to swing a 100k notional or a 500k or 20k, and then go from there. But if you're trading without any without any grasp on that, it's just a recipe for disaster.
Yeah.
Yes.
Oh, go on. Sorry.
Sorry, I was just going to say one thing. I mean, also what people don't realize is how often you can get a trade wrong in a row. Even if you're right 70% of the time, there will come a point in your trading career where suddenly you get 5 or 6 in a row wrong. It's not your system's fault. It's just the way it is. And if you risk too much, well, you've lost most of your capital by that stage.
Yeah, completely. And we quoted your test, your series, so the modeling that you did on exactly that. And was it a 50% hit rate? You're guaranteed over 100,000 trades to lose 5 in a row?
Yeah.
Which is account gone.
Yeah.
It's a guaranteed certain. And so we need to work backwards from that. So to move the conversation on then, to set the scene about where we're going to talk about this, we're going to discuss a couple of different models that we've found and that we've come across that we think sets this up pretty well. So the first is going to be based on percentage risk. And Axel, we're going to ask you about percentage risk. And the second is based on volatility. So how do you tailor your position sizing based on an external factor that you can then use to kind of help your own strategy? And I'm going to call on a piece of research that we found in in researching for this pod. But it was a paper that was published in 2023 in the Journal of Behavioral Finance. And the title of it is, and it's a very exciting title, but The Mathematics of Risk-Adjusted Returns, Position Sizing Effects on Retail Trading Performance. This is exactly kind of bringing everything together that we've been talking about. And what they found is that in their analysis of 10,000 retail trading accounts, it revealed that traders using consistent position sizing based on fixed percentage risk, and the nuances of the paper model between 1 or 2% of risk per trade, it outperformed discretionary sizes, so people that just picked it on a fly, by 43%. And that was on a risk-adjusted basis over a 24-month period, which is remarkable. So that's almost double the performance. Interestingly, if you then look at traders that employ a volatility pricing model, volatility position sizing model, if they looked at the times during 2022, during the market downturn, it showed that people using volatility adjusted position sizing kept 76% of their capital. So there was still a downturn, unavoidable, but 76%, they kept 76% of their capital versus only 42 for those that were using fixed lot sizes. So it just goes to show that having a rules-based system sets you up. And that's the way to look at it. So let's look at the first one. Firstly, should we just define the difference between trading with risk, or the risk per trade, or the risk per account? Let's have a quick look at the difference between those first. How would you define trade risk, risk per trade?
I think it's the amount of money that you're willing to lose in the worst case scenario if your stop goes. And we're talking, non-guaranteed stops that could end up with a bit of slippage or whatever it might happen. But realistically, you're saying, right, I'm going to go into something, £10 a point, 50-point stop. That's a £500 risk. And I think that's your risk sizing. And then on top of that, you've got what's the £10 per point translate to, which is what we were talking about earlier, which is the notional size. So 10 times the cost of the product, 10 times the price of the Dow, obviously very different to 10 times the price of the FTSE. And therefore, you've got to work on what your notional is, first of all, and then go from there to then work out where your stop loss needs to be, basis how much you're willing to risk.
I mean, what I do with our clients, I start from the simplest point of view, because as you say, they don't necessarily know what their notional is, they don't know what their account size is, and they say, oh, I'm trading a leveraged product. So, is it the amount of money I've got in my trading account times up to 20 or something like that, or not? So I say, basically, you need to have a figure in your mind, which is the total amount of capital you're putting at risk. So let's just say, for argument's sake, it's, £100,000.
And that's the unlevered size.
That's unleveraged, yes. But some people will have £20,000 in there and pretend it's 100,000, which is fine. You can still do that, as long as you're aware, obviously, that you're running leveraged risk. So we have to express everything in terms of leverage in that case. But let's just keep it simple and say it's unleveraged, £100,000. What I tend to say is, okay, you don't risk more than 3% maximum. Personally, that's what I do. But for clients, I say 2% maximum per trade. So that means £2,000 is your stop loss, like you just said, Pete. If your trade goes against you, and let's say it's £100 a point, so you're getting it at X, and at X minus 20, that's where your stop is. That's where your £2,000 risk is per trade. Get 10 of those wrong, you've lost 20%. You can come back from 20% loss. But imagine you risk £10,000 out of your £100,000 per trade. You get 5 of those wrong, as you said earlier on, you lose 50% of your money, and you need to make 100% to get just back to break even.
And do you look at it as well from an account-based level, so not just per trade?
Well, for me, the account is the £100,000. So whatever that is for the client, and they need to decide whether they look in terms of their account at the actual money that's in a spread betting account, for example, or is it the amount of money that they have in their mind, but they have a smaller amount in the spread betting account because they are leverage trading that account. Yeah. So you need to decide beforehand.
I guess would you go down that route? If you say 3%, you've got the £100,000 account. So you say, right, I'll risk 3,000. Is that I'd only risk 3,000 at one time? So you would only have one trade on at one time?
So if you have several trades on, what you need to make sure is, in that case, you also want to stay closer towards, 7, 8, 9% maximum perhaps, because if you get at 3%, and they all go wrong because they are correlated, then you end up again with 9 or 10% risk per trade.
Yeah, because that correlated piece is really interesting, because you could be risking 1% of your account at the FTSE, 1% of your account at the Dow, and 1% of your account at the DAX. And you think, well, I've got 3 different markets, but they all move exactly the same.
Yeah.
Exactly the same.
Well, there's correlation. Yeah, cross correlation. Yeah,
definitely.
And also what people forget about correlation, I know we're going a little bit off topic here, but it's really, really important to say that to listeners. When markets go horribly wrong with regards to people being long, so when you have these big black swan events and suddenly you've got a huge drop in equity markets, for example, what tends to happen is that people nowadays will also sell crypto, they will also sell gold, they will sell bonds, they will sell anything they can get their hands on, because the institutional traders need to get out of their positions because they need to cover their margin calls, etc. So short term, even though you would expect, for example, the US dollar to rally or gold price to go up or yields to rise, well, that's not happening in the short term because everything is just being sold off. So people need to be aware of that.
Yeah. I mean, that's what we saw in the dizzy heights of the pandemic, wasn't it? Everyone was expecting gold would get a huge bid as a defensive play, and it got absolutely smoked with the rest of the stuff because people were having to sell that to cover the margin call and other stuff, and that was just a worldwide. So yeah, it's not always the case that you've got, I've got a hedge in there that can also come under pressure. So I think you've got to just think about the whole, how much market risk have I got on right now, notional exposure, and how much am I risking with where my stops are. And I think if you got that, then it harks back to what we spoke about in the last episode, which is you've got a trading plan. And it's not necessarily just that your trading plan is, I want to make X per week. It's actually, how do I protect what I've got? And that sort of sizing is a real key point of that, I think.
It definitely is. And also, I mean, for me, it's more about capital preservation in the long term. And you can still, even with risking 3% of your capital per trade, you can still make over 100% returns on a regular basis year by year. But the problem is a lot of people want to make 500, 1,000% return, etc., and they just punt around, and that's where they go wrong.
I was just going to say, if we know that this is the case, most trading books, textbooks, people you speak to know the rules of never risk 2% of your account, 3% of your account. But why do people not do it?
Well, I guess it's the same as, that if you drink 10 pints of beer, you're going to wake up with a really bad head, but you go out and have 3 and then you have another 7, right? It's the age-old classic of, we're fallible people, we're humans, right? And as soon as you plug the robot in to do it, that will do what you want it to do, and it's dispassionate when it comes to numbers and P&L and all the rest of it. And some of our best traders are the ones who have become a bit more robotic, because they don't, they're not just high-fiving and celebrating the wins and burying the head with the losses. They're just dispassionate to it. They just go, right, it's just numbers on the screen. I'll see where I am at the end of the month, end of the year. And yeah, I think you set out with the best intentions, but it's like anything, right? It's like if you're training for a marathon, or if you're training for an Ironman, or whatever it is, you've got to have the discipline, and that discipline has to become ingrained in your habit every single day, right? And so as soon as you break that, which invariably we all will do at some stage, your plan fails, and in theory, you open yourself up to more risk. And I think you can start out, Sunday reading the paper and looking ahead for the week and all the rest of it, and Monday, right, I'm going to have position sizing and and by Wednesday you might have gone, you might be chasing your tail. You might have done, I know you've talked about it before with your trading journal. You might have had particularly bad night's sleep or something else in your life which is giving you stress, and there's something out there which just throws a spanner in the works, right? And all of a sudden you go back to doing the bad habit that you had before. So I think it's like, how often can you do the good habit? And the more you do it, over time, you'll get more aligned to how Axel trades now, which is systematic, with stops, with discipline. And, you mentioned it before we started chatting now, reducing some of your position this week because the vol had changed. And all of a sudden you go, right, the position I've got is too big for what is happening in the market. And having the foresight to see that is where we want, our clients to get to, really, is go, right, okay, let's nip that in the bud. It might mean closing a bit off and taking some P&L, but you're living to see the next day instead of going, well, I'm in now, so YOLO.
But that's because I stick to my rules. I have this set amount. Let's just say, for argument's sake, it's £1,000 per trade. If suddenly the market becomes much more volatile, like the DAX has over the last 3 days, then I just need to reduce my size in order to be able to fit my trading into that £1,000 or €1,000, let's say, if it's the DAX. And imagine, you trade one lot, that's 20 ticks. 2 lots, it's 20 ticks, and you have to reduce it to just one lot. But 20 ticks will check out straight away, in or out, because it's so volatile. So if you can make it 40 ticks or even 80 ticks, you need to reduce your size. And I think of everything I do in terms of the initial risks. I start off with what most people don't do. I start off with my position sizing, with my risk per trade. That's the number I'm looking at. That's where I place my stop. If my stop is too far away, I won't trade that trade. I'll wait for a better one. But if you think in terms of risk and your stop limits, you will get to the point where you're always disciplined and think, okay, fine. How much am I risking? How much am I trying to make? And if you then make on average more than you lose, you're fine. But most people do the opposite. And that's where you then slip, because you think, oh, I've got my stop. I'm actually going to move it further away. But if you do that, even a few times, suddenly you're no longer talking about an average £1,000 loss compared to, I don't know, an average £2,500 gain, for example. But you're talking about a £2,000 or £3,000 loss on average compared to, £2,500 gain.
I suppose you've got to balance that logical, rules-based, what we know can be consistent because we can prove it mathematically, versus that kind of animal brain, caveman, emotional, let's go at it.
Yeah.
And, you if you go on a good run, you're going to want to size up because it's just human emotions, right? I'm smashing it. I need to do better. And then invariably, the rest of the market is thinking exactly the same thing. The rest of the market is kind of powered by these animal spirits and pushing on. And that's when you see crazy volatility come through. So it's a balancing act. No one's ever going to be perfect at it. I'm sure you've had bad days where you've not followed your rules. I mean, it's also
it's human nature.
You're at this point in your career now where you've got these kind of rules carved over. I won't say how many years you've been in the industry, but it's a little bit longer than P and I. You've got these things so ingrained now that it's easy to call back on. For new clients, new traders, new investors, these are the fundamental things that you want to get towards. And you're not going to be perfect every single time. So just to summarize then, before we move on to the next pricing, the next sizing model, risk-based is define the percentage risk of your account that you're willing to take on an unlevered basis. So take your margin rates into consideration. Raw your stop first. Put your trade idea out there. When am I right? When am I wrong? If I'm having this plan at the start of my trade, my stop loss is here. You take your stop distance and you divide that number by your risk, and that's going to give you your bet size, your position size. Yeah? Yep. Perfect. Cool. Let's bank that. And let's move on to a slightly more advanced way to think about things. And let's look at scaling your position size based on volatility. So can you tell me a way where we can help clients scale based on volatility?
Well, there's a tool you can look at, which is on the platform, and you can find it's called ATR. It's right at the top, average true range. And what that does is basically, for argument's sake, let's say you set it to 10 and you trade on a daily chart, it would be the last 10 days average range on each day. So from top to bottom, and that's the average range of each day you just divide by 10. So for example, last week on the DAX, I think it was something like 300 points. In the last few days, it probably went up to 700, 800 points per day.
Yeah.
And that's why I had to reduce my trading size by half, because suddenly the ATRs become much, much wider and the volatility is so great that if I keep my same stop size, I just get stopped out all the time.
Yeah. I mean, that's probably the easiest one. Yeah. So looking at when markets are more volatile, reduce your size. And when markets are more calm, you can increase your size.
Exactly.
Because I suppose the kind of the logic on that is, if the markets are going to move anyway, you're going to be able to achieve your P&L targets with more points. But if you're happy and you've modeled that you're going to be targeting, 3 times your risk, 1R risk, 3R versus profit, it doesn't matter how quickly you get there. The number's the same. If you are then stretching everything out to try and account for this increase in range, this increase in ATR, well, then that's going to get you there.
Yeah, that's it. Like the velocity of the thing you're trading in is increasing, and you'll get ticks done in the day because of the range of the product is increased. Like in the last 24 hours, we've had a 3% U-turn in the DAX, down and up. Right, I mean that's 900 points down, 900 back up.
Don't forget the 3% up that we had on Monday.
Yeah,
so it's 3% up, 3% down, and now we're up. As of time recording this, I think we're about 2.5% up.
Yeah. And S&P last night, I was on the US session, was around 8:15 after rebounding heavily off the lows, all of a sudden 2% down in 10 minutes.
Yeah.
These things are moving. So yeah, position sizing, it's got to change in a week like this. And maybe now, for the foreseeable at the moment, with what's going on with the amount of sort of data out there, news data, and going back to sort of the Trump first era, which was all very much heavily reliant on tweets. Now it's a mixture of that and headlines from his group, his party, tariffs, all this sort of stuff. It's like you can just twist and turn. So I think positioning sizing definitely key. One of the other tools which we started to use a little bit more now with the advent of Tasty as well is the implied volatility. So now we've got the options ladders on the platform where you've got the calls and the puts next to the strikes, and you can see the IV, as we call it. So it's showing you there the implied volatility, which obviously when that is going higher, the range that you're getting on those things is much, much more. So you look at that as well and use that to then cross-correlate what size you might want to do. I'm not sure what the implied volatility is at the moment. I'll have a quick.
You can extend it. So I think this is a really interesting way to think about things, because I often have clients that look at the VIX as a way to control this volatility type of metric. And that's fine, but the VIX is specifically, I think it's 23 to 27 days worth of S&P options.
Yes.
And it's going to be super correlated to the S&P vol. Now, I've looked at this and I was speaking to Rich about it on the Trade Live show. That's fine, but we now know that 60 to 70% of options volumes are not done on the monthlies, they're done on the 0 day to expiries. So I actually think the VIX is breaking down a little bit, and I don't think it's as clean a measure of volatility as it used to be. ATR is good because it's specific to that asset class, it's specific to the previous 10 days. But to look at IV for each asset, Tasty take it one step further. So they look at IV rank. So not only do you see what the IV is on the specific assets, a specific asset at a specific time,
Yep.
You can then look at how that volatility is ranked against its own history. So the S&P at the moment is trading with an IV rank of around 60. Think about it like an RSI.
Mm-hmm. Yeah.
IVR goes between roughly kind of 20 to 80. Anything above 60 is considered quite high. Anything below 30 is probably considered quite low. Tasty, their whole thing is about taking high probability shots, doing it really small and doing it over and over again. So they want to take reasonable IVRs so that if you're going to take on risk, at least as a premium seller, you're going to get paid. That's the whole premise. But take like an 80% probability of profit and do it on markets where there is juice. That's the whole point. So if you take the S&P, 2 weeks ago, the IVR was down at 16. So in its low, basically its 16th percentile, basically wasn't volatile in the slightest. And the VIX at the same time was probably 15, I think.
Mm-hmm.
So the VIX going from 15 to now being at 20, that's gone up by 25%. Sorry, no, it's not. It's gone up by 50% from 15 to 20. Third.
About a third.
Yeah, about a third. And the IV rank on Tasty has gone from 16 to 60.
Yeah, big difference.
It's a massive difference. So if you've sold premiums, if your whole trade strategy is built upon, modeling risk on nothing happening, now you've just been blown out of the water.
Yeah.
So if you haven't got those protections in place, if you haven't then scaled, you'd need to scale your position sizes, your exposure down, because trading on an IVR of 60 is not the same as trading on an IVR of 16, and that's the S&P. It's the biggest market in the world.
Yeah. No,
that's exactly it. A lot of people don't realize that volatility plays a really, really important role in your trading, and you need to account for it, because otherwise, as you just said, Luke, you're just going to get blown out of the water. And also what's going to be much more difficult is actually managing your trades, because imagine you've got your idea for £1,000 risk per trade, as we just discussed. But if the market moves like the DAX in 5 minutes, 100 points, how can you react so quickly? Within a second, it could drop 40 points or something. So you're already stopped out if you risk £20 a point or something like that. So you need to decrease your size.
Completely. That's really key, actually, because whenever I speak to a client and I say, why don't you stop? And it's because they say, well, it's because I keep getting stopped out. What do you say to someone that goes, it's now mega volatile? Tell you what, I'm just gonna give the trade some breathing space. I'm just gonna take my stops and limits off.
Yep.
going to take some breathing space because the last 5 times I've put a stop on, I've been stopped out. I've got a negative experience with it. I'm going to let it go. And then let's say it goes right for them, right? Let's say it does. S&P, like it did yesterday, drops and it bounces heavily. Then it comes off again. But they got out scot-free and they didn't trade with a stop. What would you say?
They might get lucky once, twice, 3 times, 4 times, 5, even 6 times. But I can tell you at some stage that it's going to blow up because they're going to have that big bad trade.
Once, twice, 3 times a lady.
No, but seriously, I've seen it so many times over the years. You can be lucky. You can be, some clients are right 90% of the time, which sounds great. But if those 10% just wipe out your account because you lose so much on those 10% compared to the 90% when you're right, well, it's not worth it, is it? So I'm here for the long game. You can still get really, really good returns. And, even on something like what we do on the Monday at 10 a.m., the trade of the week, which as I keep saying, don't trade. It's not a copy trade system because you can't sort of come up with a trade idea every Monday at 10 a.m. It doesn't work like that. But even on there, over the last 6 years, so even before I joined IG, on average, I think we made 19% per year. And that with 2% capital per risk, per trade. So it's definitely possible to get really good returns. And as I say, if you know what you're doing, you can actually make 100% plus every year. What you're unlikely to do is make 1,000% or something like that, or plus if you risk 3% of capital. But you're still there to talk about it, 10 years' time and 20 years' time, which you won't be if you risk too much because you will just be unlucky at some stage and lose it all.
What happens then if you are a trend follower and you spot a trend and you want to build into the trend? Because what we're talking about is position sizing. I suppose what we're doing it from a risk perspective, we're talking about trading less, right? But there are opportunities to trade more.
Totally.
Frame that for me. How does that work?
So that's more if you're a fund manager, for example. So I know some people who do that. There's a very famous, he's an ex-fund manager now, Tom Basso in the US, for example. He would only be right about 30% of the time, yet he features in Jack Schwager's Market Wizard books. And I've been lucky enough to meet him once, and basically he really ramps up his size when he believes that he's got a view which is right, and then he runs it for years. But you can only do that if you really increase your size, if you're only right 30% of the time. But the other thing is, when he knows that he got it wrong in the past, he would get out pretty quickly. So then it's more a question of, let's go back to our £100,000 account. Let's say you're willing to risk 30% of that. You're willing to risk £30,000. Then if you have one big trade on, you could put some in, maybe 10% of your trade, and then it goes in your direction. You add another 10%, or maybe you start with 15, you add another 5, and that, you make it smaller incrementally, but you add to your size because your trade is going in the right direction and you're trading long term. This is not scalping. This is really taking a position. And sometimes fund managers do that. They also buy into a falling market in the hope it's going to reverse and then go up. And then they add bigger, but they won't start sort of, putting everything in straight from the go because they want to scale into it. But that's the case where you would scale up, you would increase your position, you would increase your risk as the trend becomes, valid, more and more valid.
Is that more of a kind of investment
it is
logic as opposed to a trading type of logic?
Well, some traders do that. If, for example, you've got a system which is right 80% of the time, in that case, you could, in theory, risk more than 3% because basically, if you're wrong 20% of the time, let's say we've got 10 trades, you get 2 of those wrong, you're risking 10%. So if you lost 20% of your capital, that's fine. But you still need to be aware that maybe you could still get 3 or 4 wrong in the row. And in that case, if you get 4 wrong, you're down to 40%. If you're willing to do that, fine. But yes, I mean, you can, and that's how people. I've seen it with IG clients. Some clients have turned £100,000 into millions pretty quickly, and that's what they're doing. They're just really, really ramping it up per trade because they have a high probability of being right. But even then, if they're not disciplined and they get a few bad ones, they can turn that £1 million profit back into nothing. So you just have to be aware of that.
Is there guidance? It's going to move the conversation on again. So we've covered risk-based models, the Van Tharp way of thinking about things. Define your percentage risk per trade per account, set your stop, and then let the maths drive your position size. We've now looked at maybe even using the average true range, using the VIX, although we've got question marks about the VIX, use the IV rank on Tasty to help you decide your position sizing. Is there different guidance for people with different account sizes? So if you're a small client and you've got 10K, for example, should you still use 1%, 2%, 3% risk? Because the numbers become so small then, there's an element of, is it worth taking the risk because the numbers become so small? And how does that change expectation for someone that's got like a medium-sized account, say, I don't know, 10 to 20,000, someone's got a £100,000 account, like a large account. Are there different criteria for different accounts?
Yes. I mean, basically, it's like, when you're with a bank, if you've got little money in your account and you're overdrawn, you pay fees, and therefore you basically proportionally pay larger fees than somebody who's got an account which is, let's say £1 million in it. They will probably even get the fees waived if they just call up their bank manager saying, oh, sorry, I didn't do this on purpose or something like that. The same with small trading accounts. If you have a small trading account, proportionally, you'll probably have to, by definition, take bigger risks because you haven't got enough capital. But maybe what you should then do is wait and trade on a demo account first, make sure your system works, make sure you're comfortable with the platform, with the app, etc. And then you start investing. And for example, with IG, what we've got is in the first 30 days of funding your account, you can trade a quarter of the normal size. So it's ideal for that purpose. And you can just try your strategy out. And then if it works, then you do £1 a point, £2, £3 a point, etc. But proportionally, it will still probably be bigger than somebody who's got a much bigger account.
So what, you're looking at 5% or?
Probably, yes. Otherwise, as you say, it probably doesn't get you doing much, really.
Yeah, and I suppose at that point, your risk is more that you lose interest with it, and so you're going to break the rules anyway.
Yeah. I mean, I saw that recently. We were looking at Tesla, for example. If you have £10,000 in your account and you want to spread bet Tesla, the margin is probably be pretty big pretty quickly. So you can't really do that efficiently. But if you were to trade, for example, the FTSE 100, yes, you can easily do that on 50 pence per point.
It comes back down to notional, right?
Yes.
It comes back to notional size. If you're trading with a 10 grand account, your unlevered size is going to be at least 50 if you're looking at stocks, because we get 20% margin rates for retail stocks, if not larger for professionals. So the logic should hopefully carry true.
Yeah, no, I think you're right. I think when I speak to certain clients that have grown their accounts over the years, it is definitely a challenge when they've got a bigger balance, because there's a tipping point where you go, well, I've run a 25K pretty well, and I managed to turn X%, and now it's a 50K account, and that's going quite well. And now, I've got it up to this. And then as soon as it becomes a really big figure, it all changes, because the size that you're commanding in the underlying is way bigger. Now, it shouldn't change, because if you've got your same risk parameters as a percentage of your account, I think that the human emotion takes over more the more size you're moving. And I had a great client who traded pretty aggressively on cable and turned a couple 100,000 into millions, like you said. And then once that account was of that size, the risk parameters didn't go up accordingly with the size. And so what took 3 weeks to make took 10 minutes to get back. And and how hard you work to get there. And how much time you spent doing it, right? And so I think that whole thing of preservation of balance is the key. If you have traded, and you've been at the coalface and you've managed to generate a large amount, which can happen on a leverage basis certainly with our product.
Oh, definitely, yeah.
You've got to then go, right, how do I protect this? Or do what we mentioned in the earlier episodes, is go back to what your starting balance was and whip that money back and go like, right, if I like running a 100K account, that's what I'm going to keep doing. And I'm going to do that for a year. And if it does go up to the big size, I'm going to take that and put it away. And I think, again, discipline. It's just the key, right?
But it's also psychological, as you say. I mean, it's human emotions, because if you trade and let's say you're risking £1,000 on your trade, and you can live with that, it's fine. If that suddenly, because you've tripled your account, becomes £3,000, maybe if you had 3 or 4 winners in a row, you've now made £12,000. You're thinking in terms of, oh, this could pay for this holiday or do that, and then you start to equate something to that money, and you're no longer thinking rationally but emotionally, and that's when it sort of just all starts to go wrong. So that's why I express everything in terms of risk units. You mentioned Van Tharp, Dr. Van Tharp earlier on, Luke, and I do exactly that. So I have my 1R, which is X, and because I'm trading a percentage of my capital per trade, when my equity curves goes up, I automatically add to my size because I'm trading a percentage of a bigger number, which becomes bigger still. And I'm just very, very disciplined with regards to the downside. And that's also going back to trade of the week. Over the last 6 years, why did we make money? Well, last year, 31% with 2% risk. If you look at the distribution of each trade, even with slippage and even with fees and everything, you're always at a 2.5% loss or something like that on average. But the winners, some of them were plus 10%, plus 12%, etc. And that's how you generate your profits. Well, you can only do that if you're rigorous with your position sizing. So don't make it too big and respect your losses, meaning you always place a stop loss and you always define your downside risk before you start thinking about the upside potential.
Yeah, completely. I mean, I would bet that 2/3, I reckon, of kind of institutional grade traders will plan, maybe even more than that, maybe the number's even higher, that will plan their trade, plan their size, plan their entry strategy, plan their exit strategy before they even execute. Sizing is a pre-trade decision.
Yep.
Not a management decision to make whilst you're facing losses, because then you're making decisions based on emotions, you're making decisions based on P&L, and you're not making it on a control basis. If I was to put a number on it, I reckon it's at least 2/3 to, if not 75, 80% of people that would do that. I'd be very surprised if there were people that didn't do that. I cannot say the same for retail traders. I would flip it on its head. I would say there's only maybe 10 to 15% of people that do think like that.
But the reason for that is that if you start off in an institutional environment, and I've been lucky enough to do that, is that if you go outside of your risk parameters as a trader, you get fired. That's it. You're out. So you don't even have, one chance. You get one trade which takes you out of your risk parameter, you're out. It's that strict. So because you always start off with thinking about risk and the capital you have to put to use, that's ingrained in you. The problem is a lot of people, when they use their own money, they start up saying, oh, it's my money, I can do whatever I want. And that's when you go wrong and you revenge trade.
You
and
should
you
even be more defensive in a way because it is your own money, right?
Yes.
You've worked hard to earn the money, paid taxes on it, whatever it might be. But you're right. You go, oh, well, I could always put in a little bit more perhaps, or, just tweak it here or move the stop here. But you should be more defensive than you would be even if you were working at the bank, right?
I agree. That's human nature again.
Yeah. You never. I suppose it's a different danger when you downgrade the family holiday.
Yeah,
because you've lost. You've given the DAX all your money.
Yeah,
well,
but that's it. But
you won't tell your wife. That's what people don't do. Or your husband.
Exactly. Yeah, or you could be like so shrewd about certain things in life, like, oh, I need to put my money in this cash ISA because it's 4.15 versus 4.1. But you'll think nothing of just tweaking an extra 10 into the spread bet. So it's really interesting, and I do think your point there about pre-sizing is important, but also the use of stops. And this is the point that we keep trying to hammer home to people, is that stops are not just for new clients. Stops should be for every single client. Like, you've been trading for years, you still trade with a stop.
Always.
Because then that if it's gone against you, you've got something that's going to take you out and you live to see another day. And your preservation of capital is key. And it's crazy the amount of clients we speak with now who are just do not use them. And I think it is that fear of being just whipped out. And that then comes down to the fact that their initial size is too big because the stop's too close.
Yeah.
So it's just an evolving conversation, I think, to have. But hopefully, hopefully some of this will land.
Yeah, completely. So let's move it on to kind of wrapping this up then. We've spoken about position sizing basically being one of the biggest contributors to success or to failure. And we've been able to kind of ream off a few studies as to why that might be the case. We've then looked at two different, I keep saying pricing models. Like I'm trying to sell
volatility.
No, two different position sizing models. A risk-based model, where you define an amount of risk of your account per position, and then a volatility-based model.
Mm-hmm.
So we take a look at those two. We've looked at those in depth. What would you say is, to kind of finish this off then, your biggest top tip that clients can take away What are your non-negotiables when it comes to position sizing?
My maximum risk. And I can hand on heart say to you that last year I did not have a single trade, not a single trade, which went over my risk limit. Not one.
Impressive.
That's how hard I worked on this and keep working on this with a trading coach, even though I've been doing it for 30 years. Because that's the key. It's the discipline to just manage your losses.
Yeah, agreed. Discipline, 100%. I mean, in my own personal trading, self-confessed wild man. So I think, at times you got to just think, right, like you say, don't manage the position when you're already in the bad area. Manage it before you put it on. Yeah. So that pre-game thought going, right, I fancy this, I like this, setup looks good, my thought process is this, the analysis I've read kind of aligns, I've got a few things all aligned, I'm ready to go, but where's my worst case scenario and how much am I willing to risk? And then going for it from there onwards. And I think working towards trying to be that point where you can say, maybe not the full year, but I can say, right, for the last quarter, I've not gone beyond the risk limit, and just go from there, gradual.
But even shorter than that, I mean, I say that to our clients when they come and see us here, in the workshops and things like that, and also on webinars. Start off with a trading journal. Look at it every Saturday, Sunday when the markets are not open, and just see, okay, which were my mistakes this week? Where did I go wrong? Which one mistake I don't want to make next week? And then you do that over the next few weeks. And if you can eliminate one, which is not easy to do, but do it every week and look at it every month and then every quarter and so forth, you will still improve your P&L greatly, because you might, with time, manage to eliminate those errors. An error for me is, for example, not using a stop.
Well, it's micro habits, isn't it?
Exactly.
Those little micro habits. I think for me, the biggest message I can say is reduce, reduce, reduce. No one ever blew an account up by getting progressively smaller. And I think when you start to think about the percentage risk model, the reason why that works is if you lose 5 trades in a row, you're reducing your size. You lose another 5 trades in a row, they're nowhere near as painful as the first 5, and vice versa. You keep getting smaller and smaller. Now, you can earn the right to get big. You can do that, but your capital preservation is the biggest thing. So reduce, reduce, reduce. This isn't meant to be boring. This isn't meant to be, a kind of sitting on the naughty step. This is, how can you trade in this business for the long run to become successful and set up your best practice. Reduce, reduce, reduce. Cool.
Yeah, totally.
Gents, thank you very much. Axel, thank you very much for joining us.
Thanks.
Sorry, it was a bit of a heavy episode, this one. I think it was really worth us getting through the kind of nuts and bolts, because I genuinely believe this is one of the most important things. So I hope you've taken something from it. Any questions, please ask. We'll be back in a fortnight with another episode, and we'll see you. Thank you very much.
Thank you for having me.